Hello, everyone. In this video, I'm going to give you some examples of how to make adjusting entries to consider the accounting changes. We have learned about the three accounting changes: change in estimate, correction of errors, and a change in accounting policies. So for each of the type of change, I'm going to give you one example to show you how we're going to make the appropriate adjusting entries. We'll start from this example. Company Calgary increases the allowance for doubtful accounts, ADA, using the old estimates. ADA would have been 65,000. The new estimate is 7,500. Okay, so this information is quite evident that this change is about a change in the estimate, okay? So we have learned that for the change in estimate, you do not go back to the prior years to make adjustments. Your adjustment is only prospective, okay? You only make adjustment in the future years, okay? So let's see in the current year, what kind of adjustment we should make. So allowance for doubtful account, okay? If we take a look at this T account, okay? Based on the old estimate, this number would have been 65,000, okay? It has a normal credit balance. However, using the new estimate, this balance should be 7,500, okay? That means to bring this balance from 65,000 to 7,500, I need to have additional credit of 5,500. And the other side of the entry, remember, in accounting, we are using double entry, right? So we credit allowance for doubtful accounts for 5,500. We are going to debit bad debt expense for 5,500, okay? So here's my journal entry. I debit bad debt expenses, 5,500, credit allowance for doubtful accounts, 5,500. So as a result, my doubtful allowance account increased by 5,500. My bad debt expenses increased by 5,500. Okay. Okay, what's the implications on the balance sheet item? So we know that net account receivable equals gross accounts receivable minus allowance for doubtful account. Okay, so if my allowance for doubtful account increased by 5,500, so my net account receivable will decrease by 5,500. Okay, so my asset decreased by 5,500. Okay, what about the income? So we know net income equals revenue minus expense, right? Minus expense. So bad debt expenses increased by 5,500. So my expenses increased by 5,500. So my income will be reduced by 5,500. Okay, so return earnings. Return earnings equals, right? In the intro financial accounting, you have learned about return earnings equals net income minus dividend. So your net income decreased by 5,500. So your return earnings decreased by 5,500. So this adjustment we made here has effects on both financial statement and income statement. On the financial statement, my asset, net account receivable, and my equity, return earnings, they both decreased by 5,500. For the income statement, my net income decreased by 5,500. Okay, I hope this is pretty clear, makes sense to you. Okay, now let's move on to the next example. In this example, company Edmonton omitted to record an invoice for 8,000 sale made on credit at the end of the previous year, and incorrectly recorded the sales in the current year. The related inventory sold has been accounted for, okay? So the company Edmonton should have recognized a sales revenue of $8,000, but that was not done, okay? So this year, they picked up on the sales transactions, okay? So this is a correction of error. This is a correction of error. So we have learned for correction of error, we have to make retrospective adjustment, okay? We have to make retrospective adjustment. So let's take a look at the prior year, okay? In the prior year, okay, you're gonna recognize this, you're gonna fix this mistake. So what you're gonna do is you have to recognize the sales, right? So you debit AR for 8,000, you credit sales for 8,000, okay? You recognize the sales. All right, so what is the income implication? So both AR and sales increased by 8,000. So income equals sales minus expenses. So my sales increased by 8,000. My net income will increase by 8,000, right? That's pretty clear. Okay, so, and then don't forget, we also made closing entries, right? We also made the closing entries. So in the closing entries, we are closing all the temporary accounts into return earnings, if you remember from the first accounting course. So all the items, accounts on the income statement are temporary accounts. So at the year end, you have to close all these temporary accounts into return earnings. So we have a sales here. We need to close this sales entry. So we're gonna reverse, we're gonna close this sales, okay? So we're gonna debit the sales, right? Because now I have a credit balance of sales 8,000. To close it, to make sales to be 0, I have to debit sales by 8,000. And then I close it into the return earnings. I credit return earnings for 8,000. Okay? So as you can see, the sales entry is canceled, right? So now my return earnings increased by 8,000. So what's the net effect on the balance sheet of prior year? So you have an increase of AR, 8,000, and you have an increase return earnings, 8,000. So that's the effect on balance sheet of the prior year. And the income statement, the net income increased by 8,000. Okay, so let's take a look at the current year. Okay, current year. Remember, all the accounts on the balance sheet are permanent accounts. Okay, are permanent accounts. So this permanent accounts balance will be carried forward to the next year, if you remember. Okay, so basically this adjustment has this balance sheet effect. Okay, this effect will be carried forward from prior year to current year. Okay, so my goal is to make entry to recognize this entry. So this is my target. I should make an entry, okay, to recognize the changes, okay, should have been carried forward to current year. So I should have made this entry. However, the company made mistakes. They incorrectly record sales in current year. So what they have done in current year is to recognize the sales. What's their journal entry? The journal entry is the sales recognition. Okay, so you're gonna debit account receivable for 8,000. You credit sales. As you can see, this entry is not correct because we want the target to be debit AR 8,000, credit return earnings, the opening balance 8,000. But the company made this entry, debit AR 8,000, credit sales 8,000. So in order to get from this mistake entry to the target, I had to make adjustment, right? I had to make adjustment so that I can achieve this target entry. That's the correct entry. So what I'm doing here, the adjustment that required is I have to debit sales. Okay, this sales is not in the current year; it's in the previous year. So I need to reverse this sales entry. I debit sales, okay? And I needed to have a adjustment to the opening return earning balance. So credit return earnings opening balance, 8,000. So I credit return earnings opening for 8,000. So if you add the black color entry plus the blue color entry, I will get my target, the red color entry, okay? Okay, so I'm kind of doing a subtraction here. So I know what I want, my target, and you know what you have done. The difference is the adjustment you have to make. That's in the blue color. So you can see the sales is reduced by 8,000. Return earnings openings is increased by 8,000. Okay, so my net income equals sales minus expenses. My sales reduced by 8,000, so my income will be reduced by 8,000, right? You should not recognize $8,000 in current year. You have done that in previous year, right? Now, how about my ending balance of return earnings? So my return earnings ending balance equals return earnings opening balance plus net income. Okay, the return earnings opening balance has increased here. This entry has increased by 8,000. The net income has reduced 8,000. So this item go up by 8,000. This item go down by 8,000. The total does not change. The total does not change, right? So as you can see that in this case, in the current year, okay, your return earning balance has no effect. So you don't have to do any, there's no change in the return earning balance, right? Okay, you can see this entry. You increase the opening balance by 8,000, but your net income has been reduced by 8,000. So the net effect is 0. So return earnings, there's no effect on return earnings, okay? Okay, so the income statement, right? The net income is reduced by 8,000. Okay, for the I side, you don't have to make adjustment. You already debit accounts receivable in the current year. That's what you need, right? You need debit AR. So you don't have to do anything further on the AR. Okay, you don't have to do anything on the return earnings. Okay, because the net effect is 0. Okay, so the only effect change is the net income is reduced by 8,000. Okay, I hope you understand this. Let's move on to the last example. Company Lethbridge changes its revenue recognition to a more conservative policy. The result is a decrease in prior year revenue by 5,000 and a decrease in current year's revenue by 3,100 relative to the accounts under the old policy. So we can see this is a change in accounting policy, right? They switched into a more conservative policy. So we learned about this. When there is a change in accounting policy, we have to make adjustment retrospectively. So in prior year, we have to recognize the decrease in revenue, right? So my journal entry is you debit the revenue for 5,000, you credit AR for 5,000, right? So you recognize the revenue decrease. So your net income expect is your revenue decreased, your net income will decrease by 5,000, okay? And then you should think about the closing entry, right? In the closing entry, you have a debit balance of revenue in order to make a revenue account to be 0, right? This is a temporary account. At the year end, you have to close all the temporary accounts balance to be 0. So now I have to reverse this. So I credit revenue for 5,000. So these two together will make it to be 0. And then I close it into return earnings, okay? I debit the return earnings for 5,000. Okay, so now you can see that the effect on the balance sheet items is both my AR and the return earnings. My AR and retained earnings, they both decreased by 5,000. Okay, they both decreased by 5,000. And on the income statement, my net income is also decreased by 5,000. So that's what happened to prior year. Okay, current year. Remember, in the current year, we have to recognize the carry forward of the permanent accounts, right? So retained earnings and AR, both are on the balance sheet. They are permanent accounts. So we have to carry forward this entry. So we're going to make this entry. We debit retained earnings for 5,000. We credit AR for 5,000. Okay, current year's effect. So remember, this change of policy also decreased the current year's revenue by 3,100. So then I'm going to debit revenue for 3,100, credit AR for 3,100. Right? Correct? Okay, so what's the effect on income? Net income equals revenue minus expenses. Revenue decrease, income decrease by 3,100. Okay, so now what's the closing entry? The closing entry would be you have to close the revenue, right? You have to close this revenue into retained earnings. So here is the debit balance. I need to close it by doing credit to the revenue for 3,100. Close it to retained earnings 3,100. Okay. So together 1 and 2. Together 1 and 2. I have to make adjustment of AR first 5,000, second 3,100. In total, I have to credit AR 8,100. So my AR asset decreased by 8,100. Similar ideas, my retained earnings 5,000, 3,100. So my retained earnings has decreased by 81,000. Okay. So that's my effect on the balance sheet item. Both asset and equity decreased by 8,100. And for the net income statement, my net income has decreased by 3,100. Okay, 3,100. So I hope that you find that this is helpful. I hope you will like this video. Thank you and have a nice day.